Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 9th of September. So let's get into the data. These are the big ticket items for the week ahead, and it kicks off on Monday with the inflation rate coming out of China. Then we move into Tuesday with a big focus on the UK that's going to dominate half this week anyway. And you can see it here, the unemployment rate. So that's the jobs report on Tuesday. And then on Wednesday, we've got the GDP number. There's a host of other readings that come alongside this, and we'll get into that. But on Wednesday, we see the US inflation rate. Now, this comes off the back of the latest jobs reports that had a little bit for everyone, quite frankly. We saw payrolls that were improved, but below expectations. We saw a massive rise in terms of wages, but we saw a decrease in terms of unemployment. So you can pick your way through it, and it can provide you with a different story for whichever, bit different theme for whichever story you want to tell. But ultimately, the question mark here is, are we still heading into a position where we could see 50 basis points cut in September? And that's something we will be talking about in the US section of the show. Thursday, we've got business confidence out of Australia, and we've got the ECB interest rate decision. Markets expecting a 25 basis point cut this time around. And it comes off the back of the Bank of Canada interest rate cut that we saw in the week just gone. So really there's an expectation as we move throughout the week. It's all about central banks continuing to ease. And so this is the month of pivots. We've waited years for this. This is the month where all the central banks start to pivot. And according to expectations, continue to cut rates pretty much every single meeting from here on in. Then as we look forward, that inflation theme continues in the US with the PPI release and the consumer sentiment survey out on Friday from the US. So here's the data for the US, the sort of big ticket items for the week. Really, it's going to be about Wednesday, quite frankly, the CPI number. Now, there's different ways to look at this, right? A lot of people will probably say you don't really care about inflation right now. All we care about is the jobs market. Are we going to see a US recession? Because if we are, then the Federal Reserve are essentially going to act in a very meaningful manner. But it's worthwhile bearing in mind that, yes, they could move in a strong manner, let's say a 50 basis point cut. But what would be the market perception, right? If you were talking to us a year ago and saying, if the Federal Reserve were to cut rates by 50 basis points, what would be the market reaction? Everyone would say it's going to be positive because finally we're out of this period where we see elevated interest rates and we're moving in a trajectory where we're going to see rates cut. It's pro-growth. It's going to be good for the economy going forward. But that might not necessarily be the case here. And so there's a number of reasons why a 50 basis point cut might be deemed as a negative. Number one, it could come in the face of economic concerns, right? If the Federal Reserve are so concerned about the economy that they feel the need to cut rates by 50 basis points, maybe that's not a particular reason to be celebrating. Also, it comes down to inflation, right? As we can see here, I mean, these are two different measures of inflation. We've also got the core PCE number, which is the headline figure that the Federal Reserve like to rely on. But as we can see here, 3.2 on the core, 2.9 on the headline. Neither of those are anywhere near the 2% target. And so if the central bank is forced into cutting rates in an extreme manner or at a fast pace at a time where inflation hasn't been defeated, what might happen to inflation as a result? Easy or loose monetary policy is inflationary by its nature. That's why they hike rates to be able to control inflation and rein it back in. And therefore, the possibility of a second wave of inflation means that people can't necessarily enjoy this easing cycle, perhaps as much as you would have thought, because everyone's instead going to be thinking about, are we going to see a second wave of inflation? And then you've got the Federal Reserve whose hands are tied. They'd have to stop cutting rates. So we'd love to see inflation move towards the downside. And if we do see inflation moving lower, then perhaps people can enjoy those interest rate cuts to a greater extent, and people can instead focus on the positives for markets. Well, the expectation is that we will see a big move towards the downside this time around. Here's the three main inflation rates to follow: the CPI, the core CPI, and that core PCE number. That Fed's favored metric at 2.62 does highlight why people are feeling quite confident that we will see plenty of cuts to come. But we do need to see these numbers continue to move downwards. And certainly if they start to turn upwards, that could be a big problem for market sentiment. Here's the breakdown in terms of the core inflation reading. And so We're at 3.2 here. The PCE number, like I said, at 2.62. This time around, we're going to see the August figure from last year stripped out. That's 0.23. And so if you look at where we were last time, 0.165, we could see a little bit of downside, but arguably we won't really see much downside this time around, probably more so next month. If we do see a decent move towards the downside, then that could be good for markets. It could also be bad for the US dollar because it does point towards a greater propensity for the central bank to cut by 50 basis points rather than just 25. In terms of the headline CPI one, this is where the big move is going to come, right? And so this is how you could see markets really reacting around this announcement. Look at the last three readings, right? We've seen one that was pretty much nothing. We've seen that was in May. We've seen June, which was negative, and then the last one was 0.155. So we're on a very different trajectory from what we saw in the first 4 months of this year. Then look at what's being stripped out. You look back at August of last year, 0.512. So this is where the whole base effects thing comes into play. Every once in a while, the base effects will play a really significant role. And this is one of those occasions. So 0.512 drops out. And let's say, for instance, we see a number akin to what happened last month, right? 0.155. Then you'd see the possibility of a decline in that headline CPI number of something like 0.3, 0.4. Pretty dramatic downside. And so let's see what markets are expecting. Headline inflation expected to drop by 0.3 down to 2.6%. So this provides the basis for markets to feel quite confident about the idea that inflation is moving in the right direction. Good for equities, bad for the US dollar, and alike. This is the expectation for the September decision. Sorry, brain freeze. September decision from the Federal Reserve. You can see essentially viewed as a coin toss. Now, I'm recording this in the wake of that latest jobs report. And so I don't necessarily think that that's really fed into this. It's probably likely to change. You can check on the CME FedWatch website. It's free to see at any time. Great site. That's going to give you an insight into how these numbers are changing. But certainly, as things stand, really, it's on a knife edge. And so data like this upcoming inflation figure from the US is going to be absolutely key. Sorry, let's just go on to a chart to talk about this exact release and exactly how it might move markets. So dollar yen is the market that I'm choosing here because essentially what we're looking at is two havens, right? So it strips out the whole idea of, you have to track whether markets are in positive or negative mood. All we need to know is, are we expecting to see the BOJ hiking rates going forwards? And we've heard from UADA that essentially they will expect to hike rates going forward. At the same time, are we going to see significant rate cuts from the Federal Reserve? And then it comes down to this whole question mark about what happens in terms of inflation, because the economy seemingly is not on a massive downward trajectory. I don't necessarily know if we'll see a recession or not, but the numbers aren't great. And so there is the basis on the economic side of things to say, right, we need to act, and potentially we want to get ahead of it here, because there's a problem with, you don't want to wait till 2% has been breached in either direction in terms of inflation before you move, because it's likely to move beyond the opposite way. In the same way, you don't want to be in a recession by the time you start cutting rates to try and resuscitate the economy, by which point it's going to take a long time for that to actually kick into the market. You could be suffering for a long period of time. So they won't want to be too slow on this. And so the perception on whether we see 50 basis points this time, 100 basis points this year, or 125 basis points this year, or 25 this time, that view around how many rate cuts we're going to get this meeting over the course of this year, over the course of the next year, those perceptions are going to be altered when we see inflation data coming out, when we see jobs data coming out, we see GDP data coming out. This time around, it's inflation. So if we see weakness in terms of inflation, which we're expecting that headline number to decline, even meeting those expectations with a drop from 2.9 to 2.6 could help strengthen the case for a 50 basis point move in September, and that could provide further downside for dollar yen. Of course, this is a daily time frame, and you can see here a lovely downtrend of late. But if we look on the monthly time frame, you can see, well, we've got a very long standing uptrend in play. that is yet to be broken, but certainly does provide the basis for lots of downside space to move into if we do break out of this. So that highlights the near term, I say near term, that the major support level of 140249 that needs to break to really give us confidence that this latest sell-off is going to continue apace. In terms of the intraday chart, you can see here that we see these sort of intraday moves lower, then we see a wider retracement, then the intraday moves lower, wider retracement. We're in that sort of intraday phase. The near-term support level to watch out for is going to be this low that we have here, 141.684, and then, like I said, below that, there we go, 142.50 essentially. But the near-term trend remains bearish. We've seen some volatility around this non-farm payrolls release. We're starting to roll over once again. I don't necessarily think the idea of 50 basis point move can be taken off the cards. As we see at the moment, it's a coin toss. But certainly if we see this big disinflation move coming into play on Wednesday in the US, that gives more ammunition for those expecting the Federal Reserve to move in a meaningful manner and come in hard with a 50 basis point move on, well, later this month. I was going to say Wednesday, but Wednesday is the inflation metric. Right. So the UK is the next area we want to be talking about. We've got two big days. It's Tuesday and Wednesday, right? Tuesday is all about jobs. Wednesday is all about the economy. So we've got GDP, we've got industrial production, manufacturing production, construction output, trade data, a whole host of data. So what we're expecting, forecast in terms of monthly GDP at 0.2 up from 0%. And all of the numbers really looking relatively healthy, 1.3% expected on GDP. Most of the sort of manufacturing production, industrial production on a monthly basis are expected to be positive. So relatively healthy stuff on that front, and improvements expected in terms of those negative readings for industrial and manufacturing production. And as we've seen from the Chinese manufacturing PMI to the ISM manufacturing PMI out in the US, manufacturing's in the doldrums, right? So don't necessarily expect it to suddenly be, signaling something great for the UK economy. We're not massively reliant on it anyway, so it's all about the services sector in the UK. Hence, UK manufacturing PMI negative, UK services PMI positive, and ultimately the composite reading is positive. And then the jobs report, we've got the unemployment rate expected to remain at 4.2, average earnings down to 4.2 from 4.5. So downside in terms of wages, which is good. Disinflation, sort of underlying inflation trends moving towards the downside. And then claimant count expected to drop dramatically from 135 to 21K, comes off the back of a very sharp move towards the upside last time around in terms of the claimant count. So this is that manufacturing and industrial production metric. You can see here this sharp decline that we saw last month. So there's a big question mark around what we're going to do from here. Is this the beginning of a sort of wider trend for a deepening of that move? Also, in terms of the jobs report, it's notable here that if you're looking at the unemployment rate, we've got the sort of headline one, and then we've got the one based on the claimant count. You can see the claimant count figure. Like I said, we saw this big jump in terms of claimant count last time around. So the claimant count was 135, but expected now back down to 21K. But certainly, if you utilize the claimant count measure of unemployment, we can see the sort of bottoming out, akin to something you're looking at in terms of US inflation, quite frankly. Look, we weren't at 4% not long ago, and now we're starting to move upwards. But last month, we saw the headline unemployment rate fall to 4.2%. So arguably nothing to see here, and everything looks hunky-dory in terms of UK unemployment. So there's some sort of differing ways of looking at things when you look at the UK jobs market at the moment, because claimant count rose sharply, unemployment rate moved significantly lower, wages moved significantly lower. So we're looking for some sort of theme where they all come in line to play out this time around. Maybe we don't. Maybe we just see more confusion, quite frankly. But yeah, as things stand, you've got sort of a little bit for everyone when it comes to the arguments. And this highlights that sort of inflation side of things. So this is where those average earnings are really declining in a meaningful manner. And as you can see here, I've added the CPI, so the UK inflation rate. It's around target anyway. But as we see those earnings rolling over and continuing to decline, so that provides further, it puts a lid on UK inflation essentially. So it provides the basis for the Bank of England to be able to cut rates going forward. So let's get onto the chart, and here we go. So this is the pound against the Swissy. And look, what we're looking at here in terms of near-term price action is some consolidation following this rally that we did see for the pound. Now, it's notable that the Swissy has been doing relatively well against many of these currencies because of the fact that people are moving out of havens such as the yen, such as the US dollar, because of this perception we're going to see a rampant period of rate cuts, and instead moving towards the likes of the Swissy, the likes of the Japanese yen. And so you would expect to see sterling Swissy really rolling over as we've seen this risk-off sentiment taking hold. We haven't necessarily seen that. And so it points towards some confidence within the UK economy and points towards a possibility of another break higher if we break out of here. What's notable here is that we have, there you go. What's notable here is that we're sort of within what looks like a sort of flag formation here, this downward sloping channel, and we're moving towards the upside. So as things stand, we're looking for a move back up towards the top end of this level, and then potentially to roll over. But then ultimately we're looking for a breakout from this pattern. So here we go. Near-term resistance levels, you're looking at 1121, 1123 as near-term resistance. If we break out from there, it points towards further upside coming into play here for sterling Swissy. To the downside, we're looking for a continuation of this consolidation. But once we sort of break through that trend line support, then it's pointing towards a possibility of a move towards the downside. So an interesting one here. It sort of looks to me like, if we look at sort of wider context, we're sort of trying to regain ground, and we've taken this pause at a time when markets are becoming very fearful. But I don't necessarily think that sort of fearfulness is going to last all too long. And therefore, it points towards a possibility of a bullish breakout when we do see markets in a more positive mindset. How long that's going to take remains to be seen. And certainly, it's been highlighted by many that September is the worst month when it comes to stocks. And then finally, I wanted to bring to your attention the Eurozone, where we've got some other small data points, but it's all about the ECB on Thursday, expected to cut rates by 0.25. This comes off the back of the Bank of Canada rate decision, where we saw them cutting by 0.25. So this is really playing into that wider narrative around easing for central banks. And so that should be good for equity markets. And so, you know, do we need to expect that, or should we just focus on what's happening in terms of the US? Because the US, yes, maybe they see a recession, maybe they don't see a recession, maybe we see some weak jobs data, but we don't see the recession. That could be a best case scenario where we possibly see the Federal Reserve cutting rates, and we don't necessarily see that collapse in terms of the US consumer. But Europe isn't the US, and Europe has its own story to tell. Now, we've got, of course, everything that's happening in Germany and weakness in that region. But you can see inflation is essentially being defeated. And so the ECB has the basis of taking action where they deem necessary to be able to lift the Eurozone economic outlook. So we can see here, expectation is for a cut down to 3.5%. Then the meeting after that is a coin toss as to whether we see another cut, and then the same kind of thing for the meeting on from there. So really there's a lot of indecision within expectations around the ECB. And so the question mark that needs answering is, you know, what should we expect beyond this? Markets pretty much know that we're going to see, you know, you don't see expectations like this 98%. And then the ECB don't cut. It's very rare that that happens, because it means that they've completely guided markets in the wrong manner. And so it's more likely than not that we're going to see this rate cut, and it's going to come down to 3.5%. And then you're going to be looking, okay, what happens next month? What happens a month after that? What should we expect from the ECB? Because bear in mind, the ECB has lower rates than many of these other banks anyway. They started this whole tightening cycle in negative rates, and now we're looking towards them and saying, you know, you have led the way. You've cut rates before the Bank of England and before the Federal Reserve. Are you going to do it every meeting, or are you going to slow it a little bit and allow the others to catch up, so you don't necessarily have this major differential in terms of interest rates? Because, of course, if there's higher interest rates in the US than in the Eurozone, you're likely to see capital flight as people move out into those investment vehicles elsewhere where they can get higher guaranteed returns. So the outlook's going to be as important as anything. But certainly markets can feel confident that we will continue to see rate cuts as we move forward. And September should be a good time if you're looking towards markets for a reaction to the fact that we're, of course, expecting to see rate cuts pretty much every single time these central banks meet. So look, this is the DAX from a long-term perspective. It's been doing really well. We rallied up into a record high, as you can see here, with the move tentatively through this 189.31. And then, of course, we've seen some questions asked of late, certainly really revolving around what's happening in the US. And we've seen the decline, the consolidation, the breakdown prior to that payrolls release. But the payrolls release has helped things. We've really seen this nice rally from here. It doesn't necessarily mean we're out the woods, but I would say if we break up through this 186.79 level, then that points towards potentially the bulls coming back into play and hopefully a focus on what's happening in the Eurozone. Doesn't mean the Eurozone is doing great. And certainly if you look at the German data, it's not. But rates are going to be cut. And there's a view that, you know, despite some near-term jitters around what's happening in the US, there's a view that the global growth should move into a good position. And whilst inflation in the US hasn't been defeated, it has for many of these other countries, and they're going to be cutting rates on a regular basis without necessarily the same kind of pressure that, you know, an uptick in terms of inflation could have on the Federal Reserve going forward. So, you know, certainly if we get into a position where we see the US having to halt their rate cuts because inflation's reared its head once again, but the Europeans don't have that position, then we could see outperformance for the likes of the DAX. So near term, 186.80 is your level to watch. If we break through that level, maybe the bulls will feel a little bit better and not necessarily so fearful around what September could bring. Certainly if we look towards Q4. You would hope to think we're going to be in for a very nice end to the year, but certainly there's some jitters at the moment, mainly revolving around the US, but it seems the jobs report has helped allay some of those fears, despite it being relatively mixed in nature.